Good afternoon, everyone, and thanks for joining us. My name is Vito D'Introno. I'm Yarra Capital Management's Chief Commercial Officer. I'm delighted to welcome you to this afternoon's webinar with Tim Toohey, Yarra's Head of Macro and Strategy, and Joel Fleming, who leads our Microcap Equity Strategy. Very shortly, Tim and Joel will take us through this afternoon's presentation entitled Reflation, Risks to Bonds and the Role of Microcaps. Before we get started though, just a couple of housekeeping items. Firstly, you're listening to this using your computer speaker system by default, and all participants are in listen-only mode. Questions can be submitted at any time during today's session by typing them into the question pane of the control panel, and we'll look to address as many questions as we can at the end of today's formal presentation. As ever, we'll aim to wrap up a little after 3:30, but for now, I'd like to hand over to Tim Toohey. Thank you, Tim.
Thanks, Vito, and welcome again for the final one, at least for me, for the year. Reflation. I guess it means different things to different people. And slide 4 of the deck, there's a simple chart that just looks at the evolution of growth through time. By a little way of history, the whole theme around reflation is a theme that's pretty dear to me because during 2016, when I headed up Goldman Sachs' economic strategy and commodity efforts in Australia and New Zealand, I led a charge inside Goldman Sachs to embrace reflation trade, which commenced in around about March of 2016, and the argument went all the way through to around about August, but eventually came to bear as one of the dominant themes for the year. It obviously coincided with the election of Donald Trump, but Trump wasn't the causal factor. And although we had significant upside to risk assets through the course of 2016, if you look at the growth revisions on this chart, it's almost hard to see. From 2016 to the time we got to the end of 2018, global growth had improved from around 3% to a little under 4%. If you look at the starting point for 2020 and into 2021, you can see a very wide gulf between starting point to where we think growth will end up. Indeed, we're running an even greater or above consensus view for where 2021 will finish at close to 6%. So while that is a strong cyclical recovery, it certainly isn't a view on structural growth. The reflation trade from an economist's point of view is really a transitional point of view, a turning point and the delta in that turning point. It says little about through cycle earnings, if you like, or longer dated levels of growth, or indeed inflation. Slide 5 probably shows the clearest signal that an economist would interpret the reflation trade via. The reference point would be the industrial cycle, and in this case, the global industrial cycle. On our calculations, and we do this from the bottom up and recalculate it globally, global industrial production is just below where we were 12 months ago. So the recovery has been relatively sharp off what was a very deep trough. Indeed, if we looked at developed market industrial production, it fell close to 20%, about 19% at its worst year on year. And that's much worse than what we did even during the financial crisis. Even in the emerging world, we had a much deeper contraction in industrial production than what we had during the financial crisis. Yet the bounce back in the emerging world, and East Asia in particular, has been so great, and we're running around about 2% higher than where we were this time last year in the emerging world, that it's been sufficient to really hide that ongoing pain in the developed world. So there's plenty of room, plenty of runway, if you like, for the developed world to continue to catch up. You can see also from the chart that you can really pick your favourite leading indicator on the industrial cycle. Here I'm just using a global PMI, new orders to inventory ratio, as a guide to where the industrial cycle will be going in coming months. It's obviously suggesting significant upside, at least into the end of Q1 of next year. But of course, that's just one measure of the reflation trade. If you're a fixed interest manager, reflation means something different. So slide 6 is a very simple chart, but it just starts to delineate the different interpretations around reflation. So going through 2016 and broking a story around reflation, it really struck me at the time that depending on who you were doing the meeting with, you were really talking about different things. If I was talking to a fixed interest manager, it was all about, well, what does this mean for the yield curve? How steep will it go? Should we play it by reflation trades, via break-even views around inflation, or should this be a real yield trade? In truth, it does seem as though in most of these cycles, break-even inflation tends to move first, and then you find that the market actually reprices the real growth environment with a lag. And the starting point here is really quite stark as well. You can see from the chart below that if bond yields weren't being partially distorted by central banks and they were reflecting the cycle already, then bond yields in the US would be materially higher. It is of interest that we tend to forget just how closely aligned global bond yields are to measures of the industrial cycle. And in recent times, the last year and a half, that association has tended to be somewhat forgotten. The stronger the reflation trade is and the longer it goes, the more likely we get to a reset point. It's of course more can be reflected in a stronger reflation trade, a stronger trade, if that reflation is coming on the back of debt-financed fiscal expenditure. Now, of course, when we think about the events of 2020, this is the biggest and most aggressive fiscal stimulus we've seen in the post-war period. So there is a level of discomfort, I think, for a traditional portfolio manager who might be running still some duration in their portfolios while we move through this transition point. The chart on slide 7 reinforce a couple of these points in different ways. You can see on the left-hand side that this is a chart I guess I've used across a number of these webinars in different ways. On the right-hand side, it's the size of the fiscal stimulus across the major economies. Of course, we're still waiting for the last leg of the US fiscal stimulus to be announced, hopefully by the conclusion of this year, if not early next year. And in terms of the areas that matter, it's really the dark blue and black lines. And of course, the size of that stimulus is something that needs to be reflected in terms of the bond issuance over the course of the next 12 to 18 months. In conjunction with the left-hand side chart, which is the size of the balance sheet expansion by the central banks, you've got this really interesting starting point as we move through into 2021. Additional bond issuance needs to occur against the backdrop that the central bank in the US and in Europe appear to be in the last leg of their QE expansion phases. So you'll get a sense from that chart in two things. One, if we're right in the interpretation of the Fed, is that this last implementation of QE is more about an extension of the time frame that they're buying to, and potentially some guidelines around how they'll think about QE relative to growth expectations. It'll be less about a large uplift in their balance sheet growth. In that context, you can get a situation where fixed interest managers will be far more concerned about the level of bond yields out over the next 6 to 12 months. Less central bank buying, more government issuance. There's also the issue of what happens if the inflation surprises on the upside. The slide 8 to show you what is, I think, a relatively unusual development at this stage of the cycle already. First of all, on slide 8, you get a strong sense that on the left-hand side, that core inflation in the US actually hasn't fallen very much, if at all, through the course of 2020. This seems pretty unusual. This is the largest economic contraction in the US since in the post-war period, and it came at a stage where most people thought that we were pretty long dated in the economic cycle anyway. So the prospects of having an element of excess capacity, the prospects of having a period of disinflation seem pretty elevated in a lot of investors' minds. Here you can see that core inflation, depending which one you want to look at, here we're using the Cleveland Fed's trim mean measure, but you can look at the Dallas Fed's measures as well, or core PCE, same message really. There's been very little disinflation in the system. And importantly, a lot of the industrial surveys, if you look on the right-hand side, you can see this is the small business surveys for pricing plans over the next few months, have been rising consistently month in, month out since the middle of the year. Indeed, a lot of these industrial surveys are telling us that core inflation could be not north of 2.5% by the middle point of 2021. So there's plenty of reasons to believe that the inflation side of the story, at least in the US, is still skewed to the upside. So even on a traditional point of view, thinking about reflation, we normally talk about in terms of the industrial cycle and in terms of asset inflation, there is a little bit of a consumer price story to be told as well. What does it mean for an equity manager? Well, slide 9, and I think we're all kind of familiar with this. I mean, if you're like me and your inbox is being filled up with everyone's outlook statements or outlook views for 2021, the phrases around reflation and the value trade or consuming. But it's really about portfolio managers getting ahead of the EPS upgrade cycle. And here in this chart, you see a pretty simple chart, but it's a pretty powerful signal as well. Again, the global PMI, the Global Manufacturing Survey, marked against where the developed markets 12-month forward EPS growth is going. So this is the consensus EPS 12-month forward view, and it gives you a pretty strong signal that we're about to see a pretty dramatic upgrade cycle coming through in the numbers. It's not unrealistic to expect that 2021 EPS growth in the developed markets will be in the order of about 20% and potentially higher. We can see what happened in the last major reflation trade coming through in 2009, 2010. And there is good reason to believe that the snapback will be more acute this time around. Of course, debt deflation cycles that we were dealing with through 2009-10 are very hard to escape from. They tend to go for longer, and they tend to have longer lingering effects. This one, being a mandated health restriction-based slowdown, together with the advent of the vaccines, gives a greater prospect of a faster snapback. So we've got an interesting environment with excess fiscal stimulus, excess monetary stimulus, the loosest financial conditions in 20 years, and a good prospect of a very strong earnings recovery. Of course, all those things feed into a movement towards cyclicals, and a movement towards industrials, and then a movement towards value, and some underperformance by those long duration plays, particularly in areas that are bond proxies and gold proxies. The snapback into value, you can see on slide 10, has commenced, although I'd say it's pretty early days in this trade. The point on this slide is that you can see the widest gulf, and here we're only showing it and indexed it to 2015, but on our data at least, it's the widest gulf between growth and value that we have in our data set. Yes, value has caught a bit over the last month and a half, but we would expect that to continue. Value in our market is a little bit different to value in the US and Japan, and to some degree Europe. It comes with some health warnings, but it is one area that, although there's a lot of talk about it, it's still relatively early days in terms of a partial normalization. You can also see on the right-hand side chart that commodities respond very directly to improvements in the industrial cycle. And here, I guess it's interesting that industrial metals have got above where we've got to in the global cycle thus far. But one thing that becomes front of mind for an equity manager is thinking about this through the prospects or through the prism of the Australian dollar. If commodity prices are moving higher, if the Australian dollar has an upside bias because of that, then they tend to think about what does that mean in terms of the companies I'm investing in, in terms of the cost base versus the US dollar revenue stream. And so we do get a lot more rotation from those offshore names back to domestic names or into the commodity sector through this phase of the cycle. When we think about it from an asset allocator, we have to go back and think about things much more broadly and perhaps more strategically. There are elements of this that clearly are already being priced to some degree. Now, I'm not pretending, although we've had this view since March that we'd see a V-shaped type recovery, I'm not pretending that equity markets have been blind to it. Of course, they have been starting to build in this trade over recent months. But you get a bit of a sense from the charts below that through this phase of the cycle, a few things tend to happen. You tend to get a bigger push out of the US dollar into emerging markets. You can see on the left-hand side chart that equity market for emerging markets vis-a-vis developed markets are already showing that improved return to some degree. But if you look back at the other reflationary trades, it still looks pretty early days on that from that perspective as well. And indeed, if you look at it relative to bond yields, then of course this is the right-hand side chart, so global equity returns versus global bond returns versus the industrial cycle. There is some degree of the recovery being priced there, as you can see. But again, if we look back at the 2009 period and the 2016 period, there is still room for this to move higher, and given the backdrop of the stimulus in the system, potentially materially higher. There is an added element here for an asset allocator to think about as well. How much do you move out of cash? How much duration do you want to run? And how much are you prepared to put into some of the more, let's say, more contentious parts of the high beta trades? How much in high yield? How much in commodities, for instance? The bias, I think, or the path of least resistance is going to be into equities. And as we move into EM equities as well, I think it will largely be the easier allocations that will occur from an asset allocation space. But it also gives this phase of the cycle a secondary issue for asset allocators, is to think about that $8 risk and the hedging required for it, or indeed the need to repatriate funds from overseas. It's typically that this phase of the cycle that we see those two things happen more materially. What's interesting about that is it's coincided with the first year of a new US president. Typically, equities attracts equity inflows and in material size in the first year post a US election. So you've got two events there that would typically see A, equities getting some allocation, but B, domestic asset allocators likely to pull some money back home, or at the very least increase their hedging. I would suggest that from the broader point here is that the reason why you can be optimistic that the cycle won't peter out too soon is that we have a central bank in the US that is saying very clearly they're not even thinking about raising interest rates. And secondly, we have the prospect that it can be self-reinforcing. Asset allocators haven't really moved much yet, and the pace of that tends to be quite slow in terms of the reallocation. But also, this time around, never has so much money been held by so few investment firms. So there's the chance that just the investment decisions of a couple of large firms can actually have quite material impacts across the broader asset space. In terms of how does microcaps fit into the reflation trade, well, slide 12 shows really the composition of the MSCI Australian Index and the composition of the MSCI Microcap Index. And it's pretty clear just from glancing at those pie charts that it's a very different mix. There's a lot more consumer discretionary, there's a lot more materials exposure, there's a lot more industrials, there's decent IT exposure, and much lower exposure in terms of the banks and the bond proxies. So you've got a lot more domestic exposure, and one thing that our nowcasting analysis shows that Australia is actually accelerating at a faster rate of economic growth now than what the US is. We're transitioning, if you like, into a faster growth phase. outperformance. And it's also because these guys are relatively small, they tend to import, they tend to do better on a rising A dollar rather than being export focused. The returns table down the bottom left-hand side of slide 12 just shows you how microcaps fared during those last two reflation trades, the 09-10 period and the 2016 period. It's pretty self-explanatory, just how the dramatic outperformance that microcaps managed to capture during those periods. So the rationale for that is it's not just because it's, they're smaller and high beta and high risk. It's because of that composition. And it's also given that the valuation arbitrage, I think, between the smalls and the micros and the larger industrials has closed, it's actually still a reasonable entry point for this space. I might stop there and hand over to Joel to round out that discussion.
Thank you, Tim, and thank you everyone for taking the time to listen to today's webinar. After the roller coaster of the year that is 2020, it's great to be looking forward with such optimism. I would like today to remind listeners about why we think microcaps should be considered as a key player in the reflation trade, and why this, combined with accelerating structural change, provides for thinking about the microcap sector as part of portfolios looking to generate capital growth in a low interest rate world. To start, a quick reminder on how we look at the microcap component of the market here at Yarra. Our investable universe is those stocks with a market cap below 250 million at initial portfolio inclusion. We know the investable universe is large, and we also know that despite the premature calling of the death of the office building, the shopping mall and airline travel, that this period will leave a permanent mark on the economy in the sense that digitisation trends, shopping habits, the use of cash have seen an acceleration in the adoption of these long-tailed themes. As we look forward, it's worth remembering two key selling points on the microcap sector. Firstly, the smaller base, more nimble and faster growth. Businesses built in the modern world, scalable, dynamic, and lacking the legacy which can anchor decision-making and make transformation almost impossible. As the world changes, are companies staying at the forefront of what their customers want, how they want services delivered, and how they businesses provide? The ability to drill down on a specific line of business. Think niche retail, like a Nick Scali or Baby Bunting. Provision of a particular software application delivered on a subscription basis, or a skill set around a niche line of business such as quality testing for the construction industry, IVF clinics, or the provision of dental services. Microcaps tend to be more domestically focused in their business, which augurs well given the reflationary expectations articulated by Tim. We are always seeking great management teams, strong business models that are appropriately financed. Structural tailwinds are an important aspect of discovering the next huge winner for investors. An environment where structural changes are accelerating and the domestic economy is starting to fire creates great opportunity for microcap companies to thrive. Also, in a time of increasing trade tensions in the region, having exposure to domestic trends is likely a positive thematic we see playing out strongly in the short to medium term. Just on the next slide, the pandemic has caused chaos across the globe, but without doubt, Australia has outperformed in terms of both health and economic outcomes. This is a strong starting point from which to look forward. As the rest of the world grapples with increasing caseloads, being exposed to the domestic economy looks to be a good bet looking out over the next 12 months. As can be seen in the data, Australians are feeling more confident. The disaster scenarios of late March were well off the mark, and with the reopening well and truly underway, we see a very supportive domestic consumer. For microcaps generally, they tend to be more domestic-facing businesses. The Aussie-US dollar strength has begun to cause some real issues on earnings translation impact given the recent strength. We've seen Appen today downgrade earnings in part due to the currency. For many microcaps importing goods, this is a positive in terms of higher gross margins and in some cases a buoyant consumer and perhaps less competition owing to COVID casualties provides a very strong operating environment. As always, we're seeking to take advantage of big structural changes. While many more of us are back in the office, the ongoing digitisation trend will be enduring. More consumers will demand to purchase online and expect a seamless experience. Cash in the economy will continue to be replaced by electronic transactions, and businesses will seek out technology solutions to enable remote working and the ability to scale up and down where required. Just on the next slide, in terms of how we've positioned the portfolio, I'd like to touch on two key themes supported by Tim's earlier discussion. Firstly, the reopening trade remains a key area of focus. We believe a combination of closed international borders, improving confidence, high savings rates, and the resulting domestic consumption will be a powerful demand tailwind through 2021. Businesses ceasing to operate. Improving confidence to get back to normal and a relaxation in rules around mobility and gathering will be supportive of strong demand, particularly where the demand hasn't disappeared, it's just been pushed out. We would highlight stocks such as Baby Bunting as being a leader in this defensive retail segment. Monash IVF and Pacific Smiles provide services that will continue to be in demand and have significant room for expansion of their offerings in the domestic market. We believe all three businesses will be beneficiaries of improved market share in coming years. The other major thematic we'd like on the back of the reflation argument is around the boom in housing construction, infrastructure, and resource development. With capital raisings for small miners picking up significantly, supportive commodity prices, and government stimulus around new housing and infrastructure, the outlook for demand looks very promising. The microcap sector offers a range of tested through the cycle management teams, good balance sheets, and trading at what we would consider attractive multiples as the near-term outlook continues to improve. Lycopodium and GR Engineering are well placed to build and design new projects and additional capacity at existing sites. Integer is set to benefit from infrastructure spend, undertaking critical quality testing. Having demerged from Cardno, improvements in the cost base and a business with a pure focus offers significant upside in our view. Coventry is a business that in simple terms provides the nuts and bolts to major infrastructure projects. Demand will improve at a time where the management team is making a significant improvement in the efficiency of the business and its approach to customer service. Just on the next slide, it would be remiss not to discuss the current IPO pipeline. We've never been busier in our workload looking at these new businesses with the IPO window well and truly open. There are 32 new listings scheduled for December alone, the majority in the microcap space. To provide a flavour of the scope of opportunities, we have an Australian spirits manufacturer, a network of clinics providing non-invasive beauty and laser treatments, civil construction business, e-commerce platform selling books, and an education technology business, to touch on just part of the cross-section of business opportunities being made available to Australian investors. Performance, as always, has been mixed, with the real test in 18 months' time as the business rolls off prospectus forecasts and moves through a number of reporting periods. As always, we seek to undertake high levels of due diligence on these opportunities and are very selective on what makes its way into the portfolio. The trend of the defensive capital raise for balance sheet repair has well and truly passed. Secondary raisings continue at pace, with the focus on new funds to take advantage of growth opportunities. Today, for instance, we've seen a range of companies seeking additional capital across the gold, graphite, nickel, pharmaceutical, and REIT sectors as an example. We would expect continued flow of new listings and secondary capital raises to continue. We also believe that M&A will be an increasing feature as companies seek to turbocharge growth, improve competitive positioning, and to take advantage of investor appetite to support growth initiatives. We believe that the microcap sector will be a very happy hunting ground for those target companies. Our expectations around the outlook for the macro environment and the domestic economy provide confidence that microcaps are set for a period of increasing relevance and prosperity as they advance their businesses, take market share, and become more robust and important components of the economy to the benefit of their shareholders. As always, it comes down to stock selection, but with a proven process that has delivered an almost 15% compound return after fees since inception, we believe we are well placed to capitalise on the positive combination of reflation and accelerating structural change. And with that, I might pass back to Vito.
Thanks, Joel. Time for questions. Quite a number have come through, so we might just get straight into it. Tim, first question for you. What do you see as the main risks to the outlook?
Yeah, thanks, Peter. I think there are, in terms of economic risks versus financial market risks, I think I'd probably delineate. It's easier, I think, to see the financial market risks. So the ones I would highlight are, first of all, it's quite clear that one of the supporting features of the recent rally was the outcome of the US election in terms of the composition of the Senate. The more negative outcome would have been a very clear sweep of the Senate by the Democrats, and the more extreme parts of their agenda, and in particular the prospects for very significant tax hikes, would have been front and centre for the market to have to deal with. That looked like it could have been in the order of a 12% EPS downgrade for the S&P 500. So that has largely been navigated. The outcome of the 5th of January runoff in Georgia is the next obvious point to look at for that. It's interesting that betting markets have the Democrats now a 1 in 3 chance. So that's a much higher probability than they had only a couple of weeks ago, partly because President Trump still is muddying the water there, and partly for some very domestic reasons inside that Georgia runoff. But the point there is that, of course, that's one potential source that you could get equity markets reassessing the risks around earnings in the US. I think the other one is related. The first years of a US election cycle tends to be when some of the strategic competitors to the US tend to test the water a little bit. And I wouldn't rule out the prospect of I'm not sure we want to call them a black swan type event, for something around a Taiwan or that sort of an issue for China to flex its muscles. Clearly, Australia's at the pointy end of China flexing muscles at the moment, but the prospect of something like that in the course of 2020 could certainly rattle markets at some point. I think the bigger risk, though, is the risk that we're talking about through the course of the presentation. I mean, the real risk for risk assets is just that we have a disorderly end to the bond, 30-year bond rally. And it could come down quite simply to either just much stronger data than people expect, a bit stronger inflation than people expect in the US, but importantly, just a misstep on behalf of the Fed. If we all cast our mind back to the taper tantrum, it was really just a miscommunication between the Fed and the money market participants. This time around, they need to find an exit from choosing the market via QE to something else. So it's a very careful transition they need to navigate to keep the market on side. I think they can do that, but I think we just need to be alert to that risk.
Great. Thanks, Tim. Joel, one for you. Microcaps have rebounded really sharply from the bottom. Are you seeing any particular sectors that look overbought?
Thanks, Vito. It's a really good question. I mean, one of the trends that we've noticed is just how many more participants are playing down in the microcap space. We've seen a lot of increases in liquidity, and we've seen some amazing share price movements during that time. What I guess the thing that really stands out to me is the short-termism that continues to flow in. It's all about the next announcement, the next data point. Our process takes a much longer term view, and that's creating what we believe to be great inefficiencies for us to exploit. But plenty of those mega trends, I think, that are front of mind at the moment, whether it be cybersecurity, digitization, those kind of things, the stocks like that have been incredibly well supported. And there's some debate about how those companies will be able to scale and capitalise on that effectively. And the other thing, I think, in resources in particular, we're seeing a lot of excitement around, one or two exploration results driving significant, kind of market cap movements. But I think, again, the opportunity for us is we take our longer term view, we do our due diligence, and that ability to find the company that is developing and small today, that in the future will be much more larger, more robust, and we continue to find those opportunities.
Great, thanks. We might continue with you, Joel, with another question, and that is, how might a market rotation back to value impact microcaps?
Yeah, again, another really good question. Unlike the other segments of the equity market, I mean, the investable universe is so large, and it does change all of the time, and you don't have huge volumes of whether it be passive money or a large number of fund managers focused in on this space. So, often there is no consensus information. They're not covered by brokers. The idea of growth versus value, people are looking for businesses that are winning and they're growing and they're doing it sustainably. So we don't particularly see a great impact from that broader rotation. Microcaps is all about picking the winners and those businesses that will go on to be successful, as opposed to the further you go up the market cap spectrum, that being a more obvious topic of conversation, notwithstanding Tim's point about the Australian market and its differences with offshore markets.
Great, thanks. And Tim, perhaps one last one for you. The dollar is trading around 74-cent mark. How effective can the RBA expect to be in holding down the Aussie dollar in a strong global growth year?
Yeah, they don't. I don't think not very. I think is the answer. The RBA's foray into QE. It's incredibly late by the standards of everybody else. It sort of has more hallmarks to when they decided to exit. Sell their gold holdings back in '97 at the low for prices. They're essentially trying to buy bonds at the peak. But the composition of what they're doing and the magnitude of what they're doing relative to what the larger central banks have been doing, it does pale into insignificance, really. And I think if the dominant market theme becomes this rotation into global cyclicals, commodities, and risk assets, the A dollar is at the pointy end of all of that. So I think they'll be spectacularly unsuccessful in holding back the A dollar through their QE program. You need to bear in mind that it's very unusual what they have chosen to do by that. I mean, they are effectively targeting three things, as they state very clearly. They want to keep down funding rates. They want to inflate asset values, which is a strange thing for a central bank to fully put out there. And they want to hold the A dollar lower than what it otherwise would have been. So there are a couple of red lines that we haven't ever crossed in Australia before, but the central bank has chosen to do it right around a period where perhaps they didn't need to, as the recovery was getting on its own way already.
Great, thank you, Tim. Very conscious of time, so we might call it there for today. I note there's a number of questions still in queue. For those of you that have asked questions, we'll try to get back to you in the next day or so with some responses. As Tim mentioned earlier on, this is our final webinar for 2020. We hope this series has helped keep you informed and engaged as we've worked as a collective through the COVID-19 pandemic. We'll look to re-engage early on in the new year with a new series of webinars from Yarra. If you're after some light content during the Christmas break, I'd encourage you to keep an eye out for the next release of our podcast called the Yarra Exchange. Early next week, we'll release the next episode with Roy Keenan, who heads up our Australian fixed income business. And that podcast can be accessed through pretty much every podcast platform you care to mention, please do give it a listen, and any feedback would be greatly appreciated. Any questions following today, or more broadly, please contact myself, Nick Green, or Ramal Hakopian. Very happy to answer out with questions or arrange a follow-up meeting with the various team members at Yarra. Following today, we'll send you a survey as always. Any feedback, greatly appreciated. It does help us plan for future events, so please do keep that feedback coming. And then finally and importantly, on behalf of Yarra, a massive thank you for joining us today. A massive thank you for your support throughout the year. Have a great afternoon, and we really do hope you manage to have an enjoyable and restful Christmas break after what I'm sure has been a pretty extreme, challenging year for us all. So looking forward to catching up in the new year. Have a great break, and bye for now. Thank you.